Hello there, and welcome to this presentation on business considerations for locally grown power factories. I'm Kent Kernahan, managing member of Ideal PV LLC, a proud Montana corporation. Oh, and we'll also get to that pesky question about stock in locally grown power factories. This is a safe harbor notice, and I just want to make it absolutely clear that this is not legal advice and not tax advice. We're not qualified to render advice on either one of those things, although we have seen a lot and there is some informed judgment as to the proposals that are contained here. However, it's very important that you form your team around competent tax equity advisors and accountants because the possibilities for this model vary extensively from state to state and jurisdiction to jurisdiction within the United States. If you're not a tax equity lawyer, consider coming back to this presentation when you have one available to you. Locally grown power factories attract a vibrant ecosystem of for-profit businesses. One of the applications for these for-profit businesses is the recapture of depreciation, investment tax credit, and other incentives, given the nonprofit nature of the factories themselves. This covers both the equipment that the factories need to procure, including leaseback arrangements for that equipment, and the tax incentives and depreciation on the solar generating stations produced by the factories themselves. Locally grown power factories can be a destination for charitable giving, especially charitable giving with a mission. There are also the possibility of creating complex relationships. For example, the same investor might give an appreciated asset to avoid capital gains impacts, and then also participate in a opportunity zone investment to defer capital gains costs for a decade. Locally grown power factories need a wide array of services. One of the more interesting ones is the management of power purchase agreements. These have to be negotiated. They can be paid for with commissions. And then, of course, there are ongoing audit requirements. Nonprofit services like grant writing, donor outreach, and accounting are also a for-profit activity. And then human resources, including compliance, benefits, and recruiting. Then there's the whole supply chain coming into the factory. So the combination of donated material, which has to be negotiated for, and proper tax accounting arranged for, procurement of purchased materials and equipment, then the scheduling and shipment of all that equipment. Now, if you missed the part about stock in a locally grown power factory, here's the important part. They're all 501c3 public charities, and public charities don't sell stock. So concentrate on the ecosystem for for-profit opportunities, not on the factory itself. All right, if that last statement didn't turn you off and you're still watching, let's set some expectations. The first one is very important. It's extremely unlikely that a locally grown power factory will be able to sell solar modules as a commodity product during the first 5 years of operation. There are some basic demands that the market places on commodity products like this, and they include some very expensive and difficult to do things for a new venture. Things like warranty reserves having a field service organization that can operate in remote sites that is far away from where the factory is located, various modes of insurance against loss. The cost controls of an early enterprise will not be as good as they will be later on. And fundamentally, it just won't have the track record. It won't have been in business long enough for installers to risk their reputations on those products. These are kind of unavoidable hurdles in the solar module commodity business. Frankly, the margins in that business are not very good. So even after 5 years, it wouldn't surprise me that most locally grown power factories will tend to stay away from selling modules as a product. Locally grown power factories will typically both manufacture and install. This is really important because the value proposition of the transformation of raw material to electrons, that has the largest possible value. So you really want to capture all those steps. It's also true that the installation group will dominate the workforce and offers a large number of workforce development opportunities, including grants and participation by local unions, re-entering workforces, that sort of thing. Why do we want this high value of transformation from a raw solar cell to a generating station? Because in order to take the maximum advantage of deductions and incentives, you want to have the largest possible tax basis. And that really happens when you're valuing the electricity generated, not the hardware. Energy has the highest value, and also that's the point at which these additional markets like carbon cap and trade kick in. At the finished solar generating station level, you have several options for determining cost basis. Of course, you can just do mark-to-market, look at similarly situated solar generating stations and value based on those. But you're also possibly going to be able to use discounted NPV on the electricity or cost plus margin basis valuations. Look for the Treasury Department's 1601 program. That's the root program that established these valuation schemes for both investment tax credits and accelerated depreciation back around 2010. Selling energy requires an installed commissioned generating station. So you will need not only the workforce within the factory, but a complete installation team all the way through the electricians and the people that you're going to need to handle all the permitting and interconnect agreements. LGB factories are most efficient when they utilize all of their advantages. There are a lot of them. It can seem like a daunting set of complexities, but really these are all opportunities. Leaving things on the table like volunteerism, both the monetary and the in-kind type of volunteerism. That is, sometimes the expertise that people are willing to donate to you are worth far more than a cash grant, for example. But there are grants, opportunities, and leasebacks as well. Want to be very careful about buying capital equipment because you can't take advantage of the accelerated depreciation for that equipment. It's almost always going to be better to arrange for a third party to purchase the equipment and lease it to the factory. LGP factories attract people and funding that are aligned with their strategic missions. So whether it's climate change or economic development for the local community or a blending of those things, you're going to have a very rich workforce and set of resources aligned with your goal sets for your community. It's also important to recognize that a 501c3 public charity is much more than a corporation that pays no tax. It is an organization that has a duty to its mission, to its charter. And the public charity designation is not easily won. This means that you have to have a broad donor support. You have to have a properly organized management team and board. And it also engenders a requirement to maintain that status. Ideal PV technology licenses require that the factory maintain this status during the entire term of the license. Fair question at this point. Why do we need a model? Ideal PV's license lets a factory do whatever it wants with its module. Could sell, give, keep them, whatever. So maybe you could just do something simple like we sell them to high-income people and give them to low-income people. What's wrong with that? Simple, right? And it's never that simple. The key element here is that your installer would have to be a really good friend of your nonprofit. And if they're not, if they're in it for the money, they're going to demand some stuff. They're going to demand you have a robust balance sheet with plenty of cash to service warranties. They're going to want 5+ years of field experience, at least a 25-year warranty, and you're going to end up buying reinsurance to offer a warranty like that. They're going to want a better price than China because they need margin to operate. And they're going to want financing from you with good terms. They may not install it in your area, which is going to make it really painful to build the field service organization that's going to be able to back them up. And it goes on and on. And after you do all that stuff, then they'll look at your technical features. It's just the way it is. American solar right now is a commodity business where solar panels are an interchangeable wholesale good. What if we reframe this? The product is the electricity. Then we keep the modules. We need a way to get the taxes out of it, so what if we lease them back to ourselves? Let's go down this road for a bit. Let's kick this off by looking at existing structures that do something like what we want to do and what infrastructures in the tax code today. The standard entities in a standard solar lease are a manufacturer, a leasing company, and a customer. In this case, Trina Solar, Solar City, which is now owned by Tesla, and a customer like Walmart. The leasing company contains two pieces, an installation group and an operations group. The installation group buys the solar panels and creates an installed solar generating station. And then it sells it to the operations group, which was in fact part of the same leasing company, and in that process establishes a tax basis. That tax basis then gets used to monetize all of these different offsets, rebates, tax credits, depreciation, etc. What's left of the net cost of the system is then used as a basis to lease the system back to the customer to recover those residual costs, the taxes paid on profits, and income for the shareholders. So that's solar leasing in a nutshell. All right, let's break this thing down. Locally grown power factory acquires raw materials, cells, frames, glass. And then it fabricates ideal PV modules, and then, separate step, installs a solar generating station. That solar generating station is then sold to a third party at fair market value. Fair market value is determined either as the discounted net present value of future electricity production or cost plus margin. And remember, there's two steps to that margin: manufacturing the ideal PV modules and then doing the solar installation, or mark to market. Once you've got an established tax basis, then you can monetize rebates, tax credits, depreciation incentives, just like in the solar leasing we just talked about. The TPO turns around and leases the system back to the LGP factory. At this point, that lease at least covers the cost, taxes, and profits net of offsets, that is profits to the investors in the TPO. The locally grown power factory operates the system for its clients under a limited right to use. Important point here, this thing never leaves the ownership of the TPO or the locally grown power factory. In fact, once the TPO has exhausted depreciation or whatever portion of depreciation is necessary for its financial goals, the system can then be donated back to the locally grown power factory for a tax deduction. That is, allows them to monetize any residual value. Let's look at this thing from a P&L point of view. On the income side, we have solar generating revenue back to the nonprofit. Since we have the solar generating station, we can sell electricity from it, power purchase agreement, and we can also collect participation fees from the client, or we could lease the equipment as a sublease to our clients. Then we basically have donations, material, and labor, volunteerism, that are offsets to our cost. On the expense side of the ledger, we have the equipment lease payment for that generating station back to the TPO, and we have our building operating expense, raw material expense, and salaries. From the TPO's point of view, its income line starts with tax deductions and incentives based on that tax basis, and the equipment lease payment that it's getting back from the nonprofit factory. On the expense side, it has to purchase the station in the first place, done in one of those three ways or another way, and pays commissions to its investors, and of course it has to pay taxes. So if we look at this in kind of a cross-coupled way, then what's an expense for the TPO is income, that purchase price for the system, to the nonprofit. And what's an expense for the nonprofit, that lease payment, is income back to the TPO, neatly hooked together. All right, let's look at the component parts of this thing. First, we'll look at it from the cost point of view. And a nonprofit can absolutely crush cost as a manufacturer. Of course, it can have the original standard cost, whatever it had to spend to buy equipment, to pay labor, etc. However, past that point, it's completely different than a C Corp. It doesn't have any shareholders to pay dividends to. It doesn't have any capital expense. Doesn't pay any taxes, of course, it's in the name. It has access to advanced technology that's only licensed to nonprofits, like FOZHS, and advanced panel architecture that allows for the production in a community setting. Then, of course, it can accept capital equipment donations, either in all or in part. It can accept component donations. Quick point, FOZHS technology allow many materials that would be defective in conventional panels to be used at full power in advanced ideal PV solar modules. Then finally, we have volunteerism, a cornerstone of any nonprofit. Partnership with academia, that is, for example, the field trial that was donated by Harvey Mudd College. Philanthropy by individuals and foundations. And then finally, government grants. All of this stuff put together can in fact drive the cost negative. That is, you can exploit so many of these opportunities that you actually take in more in cost offsets than the actual cost to produce the product. Third-party owners, well, they're standard for-profit organizations. A standard for-profit organization obviously has this price, but it's long-lasting capital equipment and it's solar. Therefore, there are rebates, accelerated depreciation, financial federal investment tax credits, and on and on and on. In fact, even things that are futuristic in some states are present in others, like cap and trade credits and feed-in tariffs. In the end, after we've taken advantage of all of these features of the for-profit TPO, what's left is the residual lease to be paid back by the nonprofit. Let's take a look at this from a margin point of view. The two parts of the margin are the price paid and the cost. Here we're showing a large price paid and a factory that's very good at controlling costs, so they actually produce a negative cost. The difference here is the gross margin. The TPO will have some unrecoverable costs that have to come out of the lease. Take that off of the gross margin, we have a net margin. Now, what we can do is to go from a case where all of the margin goes to the nonprofit, efficient as that may be, because it doesn't pay tax on that margin, by increasing the payment made from the factory to the TPO. Net margin is actually moved from the nonprofit to the TPO to provide incentives for its for-profit oriented investors. Key element here is that all of this is controllable locally. And we've got a fine set of knobs to choose in both the for-profit side and the nonprofit side. In fact, we have a lot of options. Let me just highlight one key point here. Of course, we're going to try to minimize cost and maximize incentive utilization. The Ideal PV license agreement that is part of operation of a locally grown power factory actually redistributes technology amongst all of the factories. So as new technologies are invented to make better and better versions of Ideal PV solar modules, it's available to everybody. This effectively distributes the R&D expenses incurred by Ideal PV. The benefits are distributed to all of the locally grown power network. So really the question is, for your community, what's the optimal mix? Okay, third and final way I'm going to describe this financial model, and then we're done, I promise. The United States is a choice-based economy. Real power is the diversity of opinion and optimization on what to do as a nation. Of course, we do that through our government and our voting, but we also do that through our nonprofit sector. It's a diametrically opposed system to the command economies of some of our economic opponents. When I say choice, what we do in the nonprofit sector is to allow high net worth individuals and foundations and other structures to put money into their strategic priorities, tax-free. What does that really mean? That is really spending in the tax code. In other words, we are taking what would be an appropriation that would be decided through government fiat, and we're handing that to essentially the nonprofit sector, donors and foundations, to invest in their strategic priorities. And it's an important part of our economy. $2 trillion, 5% of America's GDP is allocated this way. In addition to being able to advance their priorities through redirecting their taxes, they can also redirect their time. And we can take equipment and material and repurpose it for productive use. A lot of the equipment that you'll see in the Pomona factory, in fact, was on its way out of the country, mostly to India in this case. And nonprofits are extremely efficient at creating large GDP multipliers because they have almost no economic leakage. Really, it goes into salaries that are paid to local employees and organizations and to service to the local community. Now, we also have a choice-based system for our private sector, but in this case, maybe a little more coercive. The idea is, please do the things we want you to do, and we'll give you a tax break. Don't, we'll charge you more taxes. So accelerated depreciation is one such case to encourage investment in large pieces of capital equipment. Well, there's a lot of that encouragement that goes on. The point is that we have two sets of incentives going on. The choice model for the nonprofits, and then the tax code or tax avoidance model for the for-profits. When you pair a for-profit with a nonprofit, the way we're doing here, it does allow for private capital that has a mission. If you're going to make some money one way or the other, why not making it doing something that's important? Maybe that's environmentalism, working against climate change. Maybe that is increasing employment. It also provides an outlet for certain kinds of public finance that can only be directed to for-profit organizations. You've made it. Last slide. A blended for-profit, nonprofit business model. Two independent organizations connected by the sale of a solar generating station built and installed by a locally grown power factory to the TPO, and then the subsequent leaseback of that same solar generating station to the nonprofit locally grown power factory for operation. We're blending the personal choices of the nonprofit model with the corporate incentives of the for-profit model. Look for our other locally grown power presentations, and again, thank you so much for your time today.